Navigating the structural details of modern digital banking requires a close look at how individual institutions handle transactional access, fund liquidity, and day-to-day cash management. Digital-first financial ecosystems have drastically altered traditional paradigms of banking, leading many consumers to question the exact mechanics of liquidity when dealing with specialized online platforms. Understanding the specific structural framework of a high-yield savings provider like PiBank helps clarify how funds move, what physical access tools are provisioned, and how account holders can effectively bridge the gap between digital savings and physical currency requirements. PiBank operates primarily as a digital high-yield savings institution designed to maximize interest earnings for depositors without the overhead costs associated with traditional brick-and-mortar branch networks. Because the fundamental architectural design of the platform focuses strictly on optimized savings growth rather than transactional checking services, the product offering does not include standard everyday transaction utilities such as physical debit cards, check writing capabilities, or direct network ATM card support. Consequently, direct ATM withdrawals cannot be executed using a PiBank-issued card, as physical cards simply are not part of the standard account package. The absence of an ATM card means that account holders looking to convert their digital savings balances into physical cash must utilize alternative structural pathways for fund mobility. To access funds held within a PiBank savings account for cash needs, depositors must initiate an electronic transfer of the required capital from PiBank to an external checking or traditional bank account that provides standard debit card and ATM capabilities. Once the funds successfully clear and settle in the external linked account, physical cash withdrawals can then be performed seamlessly through standard ATM networks using the debit card associated with that external institution. Moving money outward from a PiBank account relies on specific electronic transfer protocols established by the institution. Account holders utilize approved electronic routing methods, such as wire transfers or linked external account integrations via platforms like Plaid, to move funds securely. While PiBank typically does not levy internal fees for executing outgoing wire transfers, users should always remain mindful that intermediary institutions or receiving external banks might apply their own incoming wire or transaction fees. Planning ahead for liquidity needs becomes an essential strategy, given that electronic transfers between separate banking institutions generally require standard processing windows to clear before the cash becomes accessible at an ATM terminal. Evaluating the broader scope of digital banking products highlights why certain institutions choose to exclude features like ATM cards. By stripping away the infrastructure costs tied to physical card manufacturing, ATM network maintenance fees, and point-of-sale processing overhead, online-only platforms can redirect those savings into delivering highly competitive annual percentage yields, APY, to their customer base. For savers whose primary objective is capital preservation and maximum interest accumulation over time, the lack of direct ATM access represents a minor structural trade-off in exchange for superior interest earnings and zero monthly maintenance fees. Incorporating PiBank into a broader, comprehensive personal financial strategy therefore requires a multi-account approach. Savers often pair their high-yield digital savings vehicle with a traditional local credit union or a commercial checking account that features robust ATM networks and everyday spending tools. Maintaining this clear separation between long-term or emergency savings held at PiBank and day-to-day operational cash held in a transactional checking account ensures that users enjoy the best of both worlds, maximizing the growth potential of their idle cash while retaining the flexibility to secure physical currency whenever the need arises.